And welcome. This is Mary Ellen McGonigal with your Friday afternoon MEM Edge show. And this is the show where we bring you where the action is in the broader markets, what a difference a week makes. We are going to get into everything. Take a look at those broader markets, look behind that, look always on the prowl for potential sector rotation and beyond with those sub-industry groupings that are really quite telling relative to what's shaping up in the broader markets. Also, I want to share with you some of the headline news that drove price action last week. For the most part, earnings continue to be the primary driver of the stocks that go on to exceed and gain the most, as well as the losers. That is going to be very much focused on their earnings report. But beyond that, looking at the bigger picture of the broader markets, we did get some economic data. On Wednesday, U.S. private sector jobs reports jumped in July. This is from ADP, and it historically is not to be trusted. I'll share with you why going forward, but the markets did respond negatively. And potentially even more impactful was Tuesday afternoon news that the Fitch rating agency lowered the rating for U.S. credit. And that was credited with pushing the markets down on Wednesday as well. From there, we did see Treasury yields hit a high for 2023. They did pull back as the week progressed, and I'll share with you why. We also did see volatility spike this week, and we've seen volatility has been rather dormant, but I will share with you what took place there, all with an eye towards sharing with you that there does appear to be a shift in market sentiment, and that will become clear as we move through. Also, we did see July employment numbers today, and they came in actually less jobs than expected. That was very good news. It did help interest rates pull back a bit. However, we did see hourly rates continue to remain quite high. So mixed, but generally positive. The markets initially responded in a positive way. However, we did close in the red. Not a good close for a day. That's viewed as a reversal day. So from here, next week, we are going to get some core inflation data by way of CPI and PPI on Thursday and Friday. So let's go ahead and take a look at those markets and see where did we close for the week. And here we are with the daily price chart of the S&P 500. And what we can see, certainly relative to last week, is those momentum indicators are now in negative territory. That RSI has dipped below 50. Likewise with those stochastics now in negative territory as well. So from here, the near-term outlook has shifted to negative. We from here want to take a look at potential support and resistance. We closed the week below this key 21-day simple moving average. Next area of support is going to be this 50-day simple moving average, possible area of support. Now, on the upside, we did have resistance levels close in a little bit, and that will be that high that was reached in the S&P 500 last week at that 4600 level. So that's what's taking shape in the S&P 500. It is, from my work, very notable from here to also take a look at the equal weighted S&P 500. And this is an area of the market that had been hitting certainly near-term high or very close to that as the markets were broadening out. Certainly from my work, providing more confidence in the ability for the markets to retain its uptrend. However, we did see a rather pronounced pullback in this equal weighted S&P as well, with negative momentum on those RSI and stochastics. So not what we want to see. Let's go ahead from here and take a look at those underlying 11 sectors in the S&P 500. I've added an RSI and sorted it in descending order. We can take a look at some of these areas up here at the forefront. For the most part, they are retaining their uptrends, certainly for their own each individual reasons. Energy is up here at the forefront. It is one of the few areas that is retaining its uptrend. We're seeing strong earnings among select areas in the energy space. I'll get into that a little bit. I'm going to certainly expand upon it further with my MEM Edge report, which you can trial using the link below. But from here, we can take a look at financials. And while it's not the sturdiest of uptrends, because we do have the momentum shifting a bit downward, XLF is still finding support at that upward trending 21-day simple moving average with its momentum in positive territory. Let's go ahead and move along to some of these other areas. Consumer discretionary, certainly a high growth area, and you can see the deterioration that took shape in this area. Now, today's rally, about 1.5% into the close, all about Amazon. We'll take a look at that chart. The company did come out with surprisingly strong earnings, and it is a very heavy weight in the consumer discretionary sector. So it was able to certainly deflect a bit with this emerging downtrend shaping up. So moving back, taking a look at some of these other sectors that are on the move, of course, from my work and yours as well, I'm sure you want to be aware of and stay on top of potential deterioration. Now, here we are with industrials, XLI. It did outperform a little bit, down about 1.8 versus the S&P down 2.3. However, here again, we do have the momentum metrics not heading in the right direction. So let's go down to these weaker areas down in this lower quartile. And I did want to share with you that healthcare continues to struggle, down 3% for the week. And you can see we are back in negative momentum mode up here with that RSI and a continued pullback. Now, a lot of this will be earnings related, but as we move forward, I'll share with you another sub-industry grouping in healthcare that is very indicative of the risk sentiment among investors, and it is pulling back. So also down here in this weaker area, technology did succumb to the downward pressure taking place elsewhere, and we can see that RSI in negative territory, barely finding support at that 21-day simple moving average. Actually, it did dip below it, and we did get high volume on that tech selling today. I will share with you, I know last week, for those of you that follow my show each week, I did mention 2 mega cap stocks that I had anticipated really going quite higher. I will share with you their position now relative to the broader market's pullback. Also up here, down here in this lower quartile, utilities really falling out of bed. A lot of this having to do with earnings. There were a number of utility stocks that reported disappointing numbers, pretty sharp sell-off there. So we are not seeing that normal potential rotation into those safer areas. We have utilities, REITs, and healthcare down here in this bottom quartile. Staples also a safe haven, getting hit with the broader markets as well. So from here, let's take a look beyond the 11 sectors. We're going to take a closer examination of some of these underlying sub-industry groupings and also signals that can be really quite helpful. Again, a 2-month daily price chart view using that RSI and updating it, and take a look up here at the forefront. This is certainly new, volatility index, and you can see I can only use the word spiked as it relates to the price action here. We are now up at 17 for purposes of using the volatility. When you see volatility spike, it is a negative for the broader markets, and usually using some people 16 to 18 as a range for when you really want to pay close attention. We did close the week at 17 with positive momentum there as well. So let's go ahead and take a look at some of these other areas up here at the forefront. I mentioned energy being quite constructive relative to its peers. And here we are with Brent crude oil. And it did close the week at 85. So we did see a bit of an increase in the price of oil. And that's going to be certainly one of the drivers here for these energy names to fare well. But as stated, also earnings are a big driver there in that energy grouping. Let's take a look at interest rates. I use the yield on the 10-year Treasury, and this is that spike up that I talked about that took shape this week on Wednesday into Thursday. Now, today's generally positive employment data did push the 10-year yield down, but we are still elevated above that 4% level, which is widely viewed as a metric for when growth stocks are not quite as attractive. So moving on, XRT here is holding in relatively well. It was down less than 1%. This is an equal weighted retail ETF of the S&P 500. And there definitely are areas when we talk about the markets and you think that everything is deteriorating, there are bright spots in retail. I did run a screen. Hopefully we'll have time to get to that. But many of the names that are holding in are those that are certainly undervalued relative to their historical precedence of being higher priced. And then also they have not yet reported earnings. So moving on, taking a look at some of these technology sectors, we'd be remiss to not look at semiconductors, SOXX. And here we are with a pullback in that grouping. However, we can see that it is still above that 21-day simple moving average. Your momentum here right at 50. MACD trending lower, but you do want to pay attention to this high volume that took place this week. And interestingly, I will again get more into this as I do a bit more behind the scenes work, but the high volume today was on a relatively flat close. So it is a group that is very much like many groups, energy and semiconductors, the haves and the have-nots. So it is important. I've done work on this before relative to being tuned into certain areas that may be able to withstand these downward pressures. The other item that's important to think about in your investment plan is your outlook. Are you a short-term trader or are you more an intermediate and long-term? And those intermediate and longer-term metrics still look constructive. So here we are. I talked about healthcare suffering. This is IBB, the biotech ETF. This is despite strong earnings from companies such as Amgen, unable to help this particular group. Very risky group. When you see it beginning to rally, oftentimes it will indicate investor confidence in the markets, and this clear-cut downtrend is not doing that. And from here, software stocks also pulling back, now have negative momentum. A couple of other factors shaping up in the markets is investors' really lack of appetite for any company that even has a nominal response or certainly report hiccup and those companies are pulling back very strongly. So that is keeping that in mind as well as we take a look at. Certainly technology is very important to my work as far as getting in front of those growth names. So I did want to share with you the Dow was down 1%. That is relative to, let's see if I have that listed here. We can take a look at that chart because I wanted to share with you how it is and has been maintaining, certainly relative to the other indices. It's not looking fantastic, but holding up above that 21-day simple moving average. And again, down 1% relative to the Nasdaq, down 2.8%. So I did want to take a minute here and share with you the underlying components of the Dow Jones Industrial Average. And these 30 names are much more indicative of the broader economy. Certainly 15 years ago, it was clearly purely industrial types of stocks, and they have shifted as far as the underlying holdings. Again, that 2-month daily price chart view with that RSI, and I'm going to share with you some of the names that are really helping the Dow to relatively outperform, and there will be a theme. First up here is IBM. They did report their earnings back here and entered into a very nice uptrend with positive momentum. Next up is Caterpillar. The company did come out with earnings last week. big move, about 8% gain on the day, certainly for a big heavyweight industrial type of stock. Take a look at that big volume. Pullback shaping up to be on lighter volume. So far, the theme is strong earnings. From here, I did want to share with you also Boeing came out with numbers last week, gap up. And this is what you want to see when you see a stock have a base breakout after a gap up on earnings and on big volume, a nice orderly pullback to that 10-day simple moving average with the momentum metrics still in positive territory. I talked about XLF holding in relatively well, and we are seeing that with some of these bank names. JPM, of course, reported, trying to recall when, it was at least 2.5 weeks, maybe 3. But the point of the matter is that it is retaining its uptrend. So when you're looking at the markets, I believe that it is really important to be aware of the fact that not all areas are coming under severe selling pressure. We can take a look at Goldman Sachs here, also holding in well with positive momentum. And the importance there is to not throw away the baby with the bathwater. So if you are in some of these other areas that are holding in well, again, your investment outlook and your time horizon will have everything to do with your decision as well. So let's go ahead and drill down to some of these weaker areas. Just want to point out that theme as we continue on, because I talked about earnings being that driver, and same here with Raytheon the prior week, gap down on weaker than anticipated earnings and just unable to possibly regain its upside momentum there. And then also Verizon with poor news continuing to deteriorate. AT&T is another name in that telecom space, not doing well. And in healthcare, we are seeing some of these bigger mega cap pharmaceutical companies really struggle. They are unable to reverse their downtrend, Merck being one of them and Pfizer being the other. So that's a look at the Dow, certainly sharing with you some of the stronger areas. One last look here, because we don't want to miss the energy potential move. And this is Exxon, XOM, potentially reversing its downtrend. So from here, I am going to pivot to a segment that is going to talk about buying downtrend reversals and why just one particular day is not going to be enough to, certainly from my work, convince me that that downtrend has taken place. This is that 200-day simple moving average. We can see the stock has had attempts in the past and faltered. So you will want to see more than certainly 1 or 2 days on that move above key resistance to convince me that that reversal has taken place. So here's another example of a company that reported the prior week. This is 3M, and we can see here's that gap up on earnings. And I may have mentioned this last week because it was on my watch list. But again, 1 day above this 200-day simple moving average is just not enough to be convincing that that upside momentum is truly in place. So here we are with that pullback. So one other area that I did want to let's take a look at some of these other companies. I did promise you, because if I don't, I may not remember. So we are going to take a look at Alphabet and Meta. And these are 2 names that last week I was quite positive upon. Certainly the markets were still in a nice uptrend, but let's take a look. Alphabet did pull back this week, but from my work, very orderly to the 10-day simple moving average. And this is what I talked about in my MEM Edge report. I added the stock as a buy, but I did suggest waiting for that pullback, which we did experience. Now, one thing of note on Alphabet today, and this is certainly indicative of what took shape in the broader markets, and that is this reversal into the close. So that is not bullish price action, certainly on that 1-day bar. And from here, let's go ahead and take a look at Meta Platforms, another name that experienced a nice gap up on earnings. And again, this pullback from my work is very orderly. So this is where that longer term view can provide a little bit more in the way of color as it relates to whether you want to stay with the stock or perhaps move to safer ground. Now, I did mention that bank stocks were on the move. I'm just going to take a second here and we'll look at a couple of names that already reported their earnings and are quite simply having difficulty as far as finding upside resistance, but they can conceivably, potentially, be bought on any pullback. So here's Comerica, and you can see the stock has had a very significant advance going back to prior to reporting earnings. But here we are with that 200-day simple moving average acting as upside resistance, very standard. But this period of consolidation has allowed the stock an ability for that RSI to dip out of that overbought position. So keeping an eye on that particular name. And here is another stock that had a gap up on earnings, is pulling back. But with these stocks, you will want to keep an eye on that momentum. Still up here in positive territory, but again, that 200-day simple moving average seemingly acting as a barrier. One last name we can take a look at. We did already look at Goldman. We can see with Morgan Stanley, big move on earnings, pulling back. However, in this case, we are seeing that negative shift on that RSI. So certainly not as compelling. And then also want to share with you, and I'm sure many of you know this if you are active in the markets, this concept of really how dangerous it can be to buy stocks before earnings. And I will tell you, having watched many an earnings season, this particular period now is absolutely the most reactive to earnings that I can really remember. It's really quite disturbing, might be a word, particularly if you own any of these names. But let's take a look at Block SQ. And this is a name that I talked about last week as having on my watch list to see how did they report. They were potentially reversing this downtrend, looking quite healthy. Well, here we are. They came out with their numbers. And you can see this real deterioration shaping up here, a break below this 200-day simple moving average, and very much in a downtrend. Another name that we can look at is PayPal. This also was on my watch list as it relates to keeping an eye out on their earnings. Again, here we are with only a 1-day, 2-day rally above this 200-day simple moving average. But more important is this response to earnings. It's all about the company's profit margins declining and the number of their active users also deteriorating. And you can see just how sharp that pullback was. One name that also came out, there were many of them. This was the busiest week of earnings season. Over 300 names reported, but I'm really highlighting the bigger names and those that have had the most pronounced moves. This is Expedia, EXPE, and we can see this sharp drop, super heavy volume, and it's all about the revenues deteriorating. But in turn, and you will oftentimes see this, there was a move away from travel-related stocks because this particular company is renowned for certainly being very instrumental for travelers. Now, I also want to talk about looking at and potentially buying stocks after they report earnings, because we've had so many names that have really fallen out of bed, even by only slightly coming in below estimates or just missing on profit margins and other areas. So here we are with Crocs, CROX, the manufacturer of plastic shoes, certainly widely bought. And we can see this gap down that took place the week before last regarding their earnings. And they did beat estimates. They came in ahead of estimates. They also raised their guidance for earnings going forward. There was one metric in one of their subsidiaries that was a little lighter than anticipated. And again, the company did get punished for that. But let's just take a look beyond that gap down. The stock is seemingly in a bit of a trading range here. Now, would I buy it? No, because we can see this shorter term moving average, that 10-day, as it continues to cross below longer and longer term moving averages, is known as a death cross. And we also have negative momentum. The reason I point it out is this is really when it, from my work, is very good period to put together that watch list. And simply looking at Crocs going back historically, you can see it has that precedence to be a winning name. Now, what you will want to do, of course, is make sure that the stock has broken back above each of these shorter term moving averages, get that momentum into positive territory, and at least have some semblance of knowledge that the company is on a true growth path. And as precedents, I'm going to share with you a company that reported, and take a look at their last quarter. This is Floor & Decor, FND, and the stock gapped down for their Q1 earnings and then continued to deteriorate. So having this on your radar so that you can utilize it for knowing what to look for to tell you that that gap down could be reversing. Let's take a look. The shorter term 21, 10-day trending upward above that 50-day moving average. Your momentum shifts into positive territory and you're getting nice volume on those rally days. From there, we can see that FND did break out of a flat base as it continued to trend higher. And last up is the fact that this industry group was faring well in the face of continued new and certainly already existing home sales. Now, of course, here we are again more recently with this gap down. I'm not certain if they reported earnings, but utilizing that downtrend reversal as precedents can be really quite helpful. Also want to take a look at some of these names that really fared well this week. One name is GPN, Global Payments, and take a look. This is a gap up. You really wouldn't know what was taking shape elsewhere in the markets. Gap up into a nice uptrend. Lots of good momentum shaping up there, certainly fundamentally very sound as well. So from here, you will want to add a 5-day simple moving average as your guide, and pullbacks to that 5-day ideally could be a buy point. However, the stock is a bit overbought. One other name that experienced a big gap up, again, exaggerated moves on both sides. This is Arista Networks, ANET, and we can see this gap up, super big volume, and the stock, again, at this time, retaining a presence above that 5-day simple moving average. I talked about energy, and I will just share a couple of names with you here. And I will, again, get into this more with my Sunday MEM Edge twice weekly report. This is Pioneer Natural Resources, nice 7% yielder, but we can see the uptrend that is taking shape here in this stock. It did experience a base breakout, and it's all about production in their shale fields that are really coming in well ahead of estimates. And there are sound reasons for that. But when you look at these energy names, you want to focus on those that are involved in shale as it relates to oil production. And that's it for this week. Everyone have a fantastic weekend. I'll look for you again here next Friday.